Hello, listeners. My name is Raj Singhal, and welcome to another episode of Breaking Investment Stereotypes. This episode is brought to you by Multipie.co, where we believe that investing is an ignored life skill. Our mission is to create a platform where people can come, learn, share, and collaborate through the right tools. Ultimately, we want your hard earned money to work for you. Here at Breaking Investment Stereotypes, my job is to deconstruct world class investors or wealth managers and deep dive into their investing journey professionally, personally, or both. I want to give a little guidance on how to use these shows. None of the following should be taken as an investment advice. Please see multipie.co/disclosures for more information. My guest for today is Raunak Onkar. Raunak Onkar is a co-fund manager and the research head at PPFAS Mutual Fund. After a bachelor's in IT and an MBA in finance, Raunak started his capital market journey with PPFAS over a decade ago. As an analyst, he covers a variety of businesses and sectors and is a regular speaker at PPFAS monthly financial opportunities forum series, which you can watch on YouTube. So, without further ado, please enjoy my conversation with Raunak Onkar. Hey, Raunak, uh, let me start with your career, which has been like mine. You joined Parag Parikh, which is more known as PPFAS, as a young intern and have since grown to become the co-fund manager and head of research at the AMC. So many congratulations on your journey. So can you talk a little bit about this trajectory and how was it to evolve with one organization?
Thank you, Rajkumar. Yeah, it's been a hell of a journey, and I cannot believe it's been so long. The interesting part is when I was doing my MBA, even before that, when I was doing my graduation in IT, this bug for investing got in somehow. I don't know why, and kept on reading about Buffett and Ben Graham and all those resources that everybody has read from in the beginning or the early part of their career, and that was fascinating. And by the time I was in my third year of graduation, I realized that owning an IT business was better than working for an IT organization. So the natural progression was to do an MBA. And during my MBA, there is a period of internship, and that's when I approached PPFS. It was the only company on my list. I had no other company which I could have gone to. If they would have said no, then probably I would have found something out. But the reason why BPFS was so interesting is at that time, Parag Bhai was the only person who used to write about behavioral finance in the open. And I don't think anybody from Indian markets was actually talking about those topics. And it was quite fascinating. So got lucky, got into PPFS. And it was exactly what I expected in a way that I was thinking that I would get to learn through Parag Bhai, through Rajiv, through Jigar, who was my boss at that time, through Arpit, my friend who introduced me to PPFS. And since then, the moment you step in, you go to the library, you know that people are reading very eclectic collection of books, and that continues even today. We build a good library in the organization, and it was a learning organization from the get-go. And you could understand that everybody, the emphasis was to learn and grow and help the organization that way, and that emphasis continues even today. So I think that's the brief journey how I got into PPFS, and I think it's just because I've been there for a long time and got a chance to grow with the firm, got a chance to learn from the best people I could ever imagine learning from. I think that's how I've ended up here.
So that's very fascinating. I know to have something planned out as you thought about it. That's a great one. And you spoke about behavioral part of investing, and of late I've been realizing that the behavioral aspect has been so important. So we'll come to the behavioral aspect later. But before that, how would you describe PPFAS mutual funds investment philosophy? I mean, you actually done two hats. One is research and also as a co-fund manager. And how has it evolved over last few years?
The process is actually simple. It is cliched. We generally look for good quality businesses run by competent people whom we can trust, and we don't like to overpay for those businesses. And although these three things sound very simple, but the combination of these three things coming together and actually being able to build a portfolio, that's the hard part. And of course, valuations are cyclical, so they test you. You like the business, but the price is not right, or you don't like the business, but the price is so attractive. What do you do about it? Or people, so the first emphasis has always been that you find the right people. I mean, if you can understand the business, that is one step. You can understand the accounting, that is the second step. But can you really trust the people? And that is from the past actions of the business promoters or the management. You get a chance to see how they have behaved, and the real emphasis goes there, and that is the make or break decision for the investing, creating the portfolio from that point of view. And I think uh, from a research perspective, what we do is we spread out, don't want to spread out too thin across too many companies and too many sectors. So we pre-filter a lot of these things. We make an investment universe. Currently, the investment universe comprises of around 700 companies, which is in itself a very large list. And I think 2/3 of it are Indian businesses, and a third of them are international businesses, because we also are able to invest outside of India. Within that list, we divide across sectors, and we try and tell the analysts that they need to become the sector experts so that they can give us good insights. They can tell us when is the right time to invest in something, when is the right time to hold or sell something. And that's what informs the investment team's decision about where we want to steer the portfolio.
Yeah. So we'll come to that's very interesting about you guys, that you're kind of a pioneer about actively investing offshore as well, and we'll come to that later. But one debate, and you spoke about this whole spectrum of companies, about 700, and you have all kind of companies in that. One debate in industry is around the relevance of valuation, right, or P specifically for long-term investing. So what's your take on this? I mean, how do you think the broader market or pockets therein are overvalued now, as a lot of people say, as seen from the typical lens of P ratio?
So I think PE ratio, just like many of the other valuation multiples, they are just a metric that you use to quickly gauge in comparison with something else. So these are all relative metrics in technical language, if you can say that. And what relative metrics means is, if you want to compare two companies whose earnings are sustainable and can grow consistently over a long period of time, then comparing their PE ratios in the same industry might give you some idea that where the market is evaluating where the company is in terms of quality, in terms of its growth prospects, etc. Then you have other ratios that you can add. You can have a cash flow yield, you can have a dividend yield, you can have your basic Gordon growth model or dividend discount model, which have been the classic corporate finance models to value companies. The point is, not one thing will tell you the right answer. In fact, we don't even want the right answer, because valuation generally is a range. It's not going to be a very precise decimal accurate answer where we say that, okay, if the PE multiple hits this particular target, then we are supposed to buy, or if it hits the particular target, then we're supposed to sell. We'll actually look at PE multiples or any of these valuation multiples as a range of indicators which give us a good idea of where the particular business is trading at. And you can then compare across various cycles. You can compare that across various points in the business as to where they are in the growth phase, how big that company is in terms of assets, and how those assets have scaled. So you can overlay a lot of other information on top of that, and then it gives you a sense that, okay, the PE multiple or any other valuation multiple you've used makes sense to look at from that point of view. To give you an example, for the longest time, we have been studying the business called Amazon. And Amazon, if you see just from a price to earnings multiple, has mostly been in triple digits throughout its history. I mean, a long part of the history of the listing of this business has been in triple digit price to earnings multiple. And famously, if you read the annual report and the shareholder letter by Jeff Bezos, we get the focus on cash flows. But the investors that we are, in terms of the Ben Graham mindset that we have to find cheap price to earning multiple businesses, you tend to gravitate towards companies who are, okay, it's a good enough business run by good people, but let me just not pay too much in terms of PE. But then you have to question yourself, is PE the right metric? If the companies, I mean, if you look at the annual reports in the US, most of them start with the balance sheet, the income statement, and then the cash flow statement. The Amazon's annual report is unique. It starts with the cash flow statement. The first thing you see is what the company's operating cash flow is. And that's a unique way of looking at things. And if the management is running their business with that focus, it only makes sense for the investors also to look at the same metrics as they judge themselves. So it took us a while for us to understand the different segments of the business. Despite being customers of Amazon, we could not become investors of Amazon as soon as the company hit in India. So it took us a while to readjust our scales and say that, okay, maybe PE is not the right multiple to look at this company. Let's look at another multiple, say a free cash flow or an operating cash flow yield, and how the cost of capital of this business is compared to that over a period of time. And are they incrementally generating higher rates of return by investing their own cash flow internally? So they have not raised money from the outside. They have borrowed a little bit here and there, but they haven't really raised money from the outside. So it's a self-sustaining machine where some business generates cash, it is deployed somewhere else at an incrementally higher rate. And then you get lucky in terms of which pockets of the business works. That's a different aspect, which cannot be captured in the PE from the get-go. So I think any multiple we look at is going to be a range and not a precise target or a decimal accurate number. And that's where I think the first genesis of the idea started, that maybe is this the right metric to look at, or is a combination of various metrics to look at?
I think Amazon is a very interesting example, and I was just reading that I mean you're right about their they focus on the cash flow statement, and then they keep generating cash in one business and deploy another. And AWS was a clear example of where actually they deployed and it became such a huge business for them. It also does one more thing, that since you're not profitable, because you're spending money actually as investment, and a lot of that is going in intangible investments as well, which is becoming a great focus of after people like Michael Mobishin and all those have started speaking about. The competition doesn't focus too much, because they're only focusing on that you're not profitable, you're burning money, and how long will you sustain by burning money. But they're not realizing that by the time they have gone ahead so long that nobody can catch them, right? I mean, I was always amazed that Jeff Bezos was able to hold 25% of equity of such a large company and never diluted, because they never raised external equity, right? So it's incredible to learn some of those businesses. I'll come to and I heard you talk a lot about your concept on conviction, being one of your core principles. So can you explain your process of building conviction in a thesis, either as an industry or a stock, and why is that so important?
So conviction, I think, is a concept I have read when I was learning about investing. I still learn, and a lot of these senior investors, they talk about conviction either directly or indirectly about talking about their investment journeys. And the point is, nobody has defined it. So I just took it upon myself to put a definition to it, saying that if you can take a calculated risk with confidence and you can stick with that decision, that's your conviction. And there have been a lot of frameworks. So the most popular framework, which was easy for me to visualize, was the three-pronged approach, that you build some informational edge, then you build some analytical edge, and then you marry that with the behavioral edge. So the information edge is easy. You just uncover as much information as you can about a business and build that mental framework of how the company works, how the people work. And by information, I don't mean insider information. This is like a long-term trend of how the business has performed, how the sector has performed. And insider information, the cheapest and the most easiest to get, but it's pointless, because then you have to keep on relying on that same source or a different source to tell you short-term triggers. In fact, if you're looking at a longer term trend, what helps you is to see what the company has done, what the industry is doing, build that information database first. The problem with information is it is only data, it is not knowledge. So then you have to analyze that data, you have to then figure out what is useful, filter out the less useful part, then look at only the data which is really relevant for that particular business, and then you build an analytical framework on top of that. And that framework can be very simple. I mean, the term sounds very sophisticated, but it is not. It's basically, if you want to look at the paints business, then you want to understand how is their distribution, how is their gross profit margin, how is their return on capital over a period of time, how much they save on manufacturing in different types of categories, how is the segment mix. All those analytical aspects you can build on top of that, and you compare all these analytical aspects with the other competing businesses in that category. And thirdly, I think is the most critical part, where we don't give too much thought because there is no framework available over there. It's just a temperament which you build over a period of time. So if you are a temperament of a person where you want to trade more often and you don't trust information at all, you don't trust yourself at all in terms of being able to hold on to something which is valuable, you might go in and out of really good businesses and you may not get a chance to get into them again at a good price. If you are a person with a temperament where saying, okay, if I've made a decision, I will hold on to it, I will keep on monitoring it for a while, and that gives you a long enough time frame to study the business and invest, and then you meaningfully build a portfolio around that, then you have a longer term template. I mean, these things sound very easy to say, but every day when you see the prices and your portfolio moving up and down, the temperament is the part where all the information analytical work really pays off, where you're able to hold on to good ideas, where you're able to enter at the right price, where everybody is screaming that the world is on fire. You need to just see through the smoke and say, okay, this is a particular thing which is interesting and this is available at a cheap valuation. Let me just pick something up in my portfolio because it's always been in my list. So I think the investment universe helps there, because then you can track all these companies you like. They may not be investable immediately, but they give you some kind of a grocery list that, okay, this, if this happens, then this can be a good part of the portfolio at a certain valuation. So you build that temperament over a period of time. It doesn't come immediately. So I don't still think that I have the temperament to really be a very good investor. Maybe time will tell. But I think the first two bits is the invest information edge and the analytical edge can be built by discipline and a good work ethic. The temperament actually just time in the market. If you survive, then you learn. If you learn, then you can apply and see test different scenarios, and you can diversify. So diversification, I think, is the easiest template to follow from behavioral point of view. That if you're not sure about one or two businesses, then maybe own 10, maybe own 20, maybe own 30. I mean, depending on how diverse you are and how much time you have in tracking all these positions.
I think temperament is also more about understanding yourself as well, right? And it's a big part of the whole behavioral analysis which somebody needs to do. And we normally, most of the people actually don't do that. And then we'll come to some of this in the later part. I want to bring in this, thing about this whole modern monopolies. And, we had recently had Saurabh Mukherjee on our podcast as well. And he talks a lot about that. How do you define a moat in the current age? I mean, and do you think the technology companies have an edge in the near future?
I think traditionally what moat is, I mean, these are all academic words that we are using now, like moat or a competitive advantage and all those things. But how does it translate to the financial metrics of a particular business? So if a company can sustain its gross margin over a long period of time, if a company can sustain the return on capital for a long period of time, or even grow it over a period of time, if a company can also grow its sales and profits over a long period of time, it can be whatever growth rate, doesn't matter. But of course there is competition, there is new forces coming in, international companies coming into your country and selling in the same category. But despite all of this, you can still maintain your business well. I think then theoretically the company has a good moat, which is a good defense against the competitors out there. Now how this moat is created is a totally different ball game. So it is difficult to learn from the outside what is happening, first of all. And most companies will not just come and tell you, hey, this is my competitive advantage and this is what I'm doing, so you can copy if you want. And no, you cannot be that arrogant. Most companies are very, very secretive. They're competitive organizations, and that is the fun part of understanding. The analysis is over there, where you talk to different people in the industry. You build a network of people who are telling you that, okay, in this industry this is happening, this is what has happened in the past, so this is the trend, and then you piece it together yourself. You may get it wrong, but the point is the effort has to be put in to understand where is the source of this competitive advantage. I mean, the outcome is known, but the process is generally not known as to how that thing has gone from cause to effect. So that is one thing. So from a simple definition point of view, I think the definition of moat has not changed, but the way you approach understanding that moat should be changed over a period of time as you try different businesses. So for example, again, a company like Amazon, bulk of its incremental value we knew was coming from a business which they are new at. At that time, they were new at, which was a cloud computing business. And okay, we knew e-commerce, we understood retail, we understood the marketplace business, and little bit of prime, the media business also. But what is this cloud computing business, and where do you get the competitive advantage over there? So you talk to people in the technology field, you understand how these companies work, what are the gross margins for running this particular business, what are the incremental innovations happening, how are people adopting it. Some of the things you also learn when you become a customer yourself. So the PPFAS app is using AWS to some extent for some functions, and once you log in, you realize the whole world of AWS gadgets and features available at your disposal to run your app properly, to make sure how you're using the service servers and how much time you're spending over there, how much money you're spending over there, how it can be optimized, what new incremental features can help you run the app better and save money. So when you see all those things happening, I mean, we are a very small organization with a small development team who can do that. But if you scale it up to much larger organizations who are now depending on the cloud, you immediately see that there is value over there. And not just for Amazon, any of the competitors who are having a good cloud computing business available. So this information doesn't come to you maybe in the annual report. It won't come to you by reading some media articles or just talking to a few people. You over a period of time, keep on incrementally building that knowledge and not knowing where it is leading to. But your goal is known, that you have to understand this business as to what is happening. And you can in the end have only two options. One is you understand to some extent where the probability of you getting it wrong is lower, so you then pull the trigger and say, okay, now this makes sense to invest. Or the other one is you put it in a too difficult box, then it's something which is impossible to understand and I won't be able to track it or understand it at all. So you put it in that box and that company then goes out of your radar altogether. So I think the conviction, moat, and all these things are built in together, where If you put in the effort to understand the competitive advantage, only then that moat is valuable to you as an investor. Otherwise, it exists in some realm, imaginary fantasy land, where you are not able to see it from your vantage point.
So I think you mentioned about, while talking about conviction, about this whole information and how do you consume the incoming information as well. So there is a little doubt that we are in an information age. Uh, uh, and how do one approach behavioral aspect of investing given the so much of information overload? How do you decide what information to consume and what to ignore, right? I mean, they say that the amount of technical information is doubling every 2 years, which basically means that a student who's starting a 4-year technical college, half of what they learn in their first year of study will be outdated by their third year of study. So how does one navigate this whole overload of information?
So academically, I go back to the example of my IT graduation days, where we learned about the semiconductor chip, which was called 8086. Now it is the
Mm.
very oldest model of the microprocessor out there, which is, I think, 10,000, 15,000 times less powerful than what we are using today right now to talk to each other. So, I mean, even more than that. I think this is even less powerful than current computer. But the point is, you have to learn some basics somewhere. So academics will prepare you to some extent to understand the basics as to what has been taught in the past. Like, for example, in finance, the basics of this will be how to understand compounding, how to understand financial accounting, how to understand basically corporate finance, and understand how the budgeting happens in the company, how decisions are made inside the company. And whichever role you take in finance, all these things will help you to build that foundation. That is it is a must. I mean, anybody, if you are not even qualified with a certification with you, you have to still read it to understand what is actually happening in the company's balance sheet or the company's financial statements. The second bit is to build the habit of consuming what is relevant, and that doesn't come very easy. So I mean, if I look at myself 10 years back when I used to read annual reports, I used to go cover to cover like an idiot. Now I feel like an idiot, but at that time it was necessary to go from cover to cover to know what was relevant inside that piece of document and what was not relevant. So then over a period of time, you start building filters. Okay, in a company like this, these kind of numbers are more relevant. So you focus on those numbers more. And I think now we are in a situation where the data is already laid out to you. So there are free tools available like Ticker or Screener, where all the numbers are laid out. You have tools like Tijori who have the operating metrics also laid out to you, the competitor analysis also done for you. So most of the stuff which you would have read the annual report for is already being displayed for you and for free for everyone to use. So it's not like the financial institutions have a monopoly on some information or not. The second point is, if you understand that information is out there and you have learned to filter it, now you have to synthesize it. So I mean, there should be an archival system where you remember what you have read. So for that reason, you have to keep going back to it again and again. So that's why you need to have a limited number of companies you can track, so that that information which is relevant for you, you can keep updating that over a period of time. The moment you have like a huge number of companies to track by as an individual, it becomes very hard to synthesize everything properly because you're reading everything. And thirdly, most people have this dramatic approach. So I read this book by Cal Newport called Deep Work, and it has profoundly moved and created some good habits for me. But at the same time, I find some of the things to be very radical. So of course, different people have different ways of implementing it. But his thing is, you unplug completely from social media and everything, and you sit and do your work for a few hours at a stretch. And that, I think, is the most important thing I start to follow. You keep your mobile phone away, you keep your notifications on pause, and when you're reading something critical or reading something which is like a good dense information piece, like an annual report or an industry report, or just studying an industry for that matter, it can be day in day out, you can do it for a few months at an end. But basically you're doing that work, you need to dedicate a few blocks of time in a few blocks of hours in a day to keep on doing it. It's like studying for an exam. You cannot just read for 5-10 minutes, then go on your Instagram and scroll the feed and come back and read something, and then expect you to remember and retain and synthesize everything the way you want. So I think that kind of a habit, which is a little radical for most people, I think it is required to be followed because we are distracted very easily, to be quite often. Thirdly, once you have that concentration, once you have the information sources which you want to learn from, everything in place, then all you have to do is start putting it together. And that does not take too much time, because once you know what you're looking at, you know exactly where to look for different guidance. If you want to talk to somebody in a particular industry, you know exactly which person to tap. And for that, you use your creativity. You tap into your immediate network of friends, you tap into the LinkedIn network, professional networks, you reach out to people, you do cold calling. there's a lot of on the ground work which is invisible from the outside. And there are then patterns which you can use. So for example, there are two books which I found extremely useful. One book is by James Valentine. It's called, I forgot the title of the book, unfortunately. The book is called Best Practices for Equity Analysts. That is the title of the book. Sorry, I just remembered. So if you read that book, it's like a time and motion study of an analyst. Like somebody put a camera on the person's head and they watched him do the work, him or her do the work. And if you see, it gives you all these day-to-day habits of what an analyst does. It can be a sell side or a buy side. And now these are the observational habits. Okay, this is how the person spent that time to do that particular work. And of course, everybody has limited time in the day, but how to optimize that? So a book like Michael Shern's Investment Checklist, which again is one of the most profound books I've read, because it's a comprehensive list of some 300 questions which you can ask about a particular business. And if you answer those questions, you know everything there is to know about that particular business. Is that enough? It's not, because incrementally information will keep coming up, but at least it will set up a good foundation of how to filter your information. Now I'm giving you these bookish examples because it's easy, because it's already available out there. If these books were not available out there, probably I would have written a book about them. But since they're already out there, these are easier to use, and you can implement these templates by choice. You can just choose what works for you and create all these network of information sources and the discipline of daily sitting in one place and doing your work.
So we'll look forward to reading your book whenever you get the opportunity to write that. But you interesting topic you talked about is the coming to the zone and detoxing from digital media, reclaiming your time. And actually, incidentally, there is an app now called Reclaim. So it basically you can add to your calendar, and then it puts a blocks of time during the day, whatever you want, 1 hour, 2 hour, and block that time for whatever purpose you want to. But of course, the big part of everything, all of that, is your own discipline, right? I mean, the calendar may tell you what to do, but if you don't do it, that's your problem. I think it's a good segue. We should get into the whole topic of the behavioral analysis as well. And you mentioned that you learned a lot from Parag Parikh J. So let's dwell a bit more into the behavioral bias. And there are a lot of biases. And I was just reading, incidentally, today only a paper from the Fidelity on that. There are biases like anchoring bias, confirmation bias. And right, Muhammad Ali said that I don't know what I'm talking about, but I know that I'm right. So a lot of people have their own biases: recency bias, herd bias, ambiguity aversion bias, and there is a great Daniel Ellsberg paradox on it. Myopic loss bias, with more pain in loss. There's more pain in the loss than more gain in the profit. So can you talk a bit more detail about, in terms of, because you've been a great student of a behavioral science as well, especially from the investing point of view, help us understand your way of thinking through all this.
So I think, like most people, my education of behavioral biases started from Parag Bhai's articles and talking to Parag Bhai. Parag Bhai's books also mention all of these things. The interesting thing was, the next step was to read about the sources from where these biases were researched and who discovered them, to be honest. So then you naturally come to Daniel Kahneman, Amos, Tversky, their research on all these different biases. And because the experiments that they conducted over the past several decades have informed them that humans are inherently biased. And if you have read Daniel Kahneman's life story, he also admits that this is not something you can cure yourself of. And this is something which was a little disheartening, because okay, I'm aware of all these biases, and I know what actions I need to take to mitigate some of these biases, but then there is no guarantee that you will be able to, and you will not even know that you have been succumbed to a bias or not until somebody points out, hey, this is your bias that you're looking at right now. So that was a little disheartening, to be very honest. But the interesting point is, there is another school of thought which considers that Daniel Kahneman's story as only incomplete. I would say a foundation to understanding that there are biases. Then there is a school of thought, and one person who has written very well about this topic is Gerd Gigerenzer from the Max Planck Institute, and his books are out there. It's a fascinating to read all his books and papers as well. But he says that all these biases that we talk about are not something we should avoid, but it is something we should try and cultivate and try and control them sequentially. It should not be something where you say you can completely block yourself from confirmation bias, you can completely block yourself from anchoring, but he's saying use it in a meaningful way while making decisions. So one film I like about this particular topic is the film called Sully, the Tom Hanks movie. The Clint Eastwood directed a movie, and I absolutely love it because some of the things that he does. So I'm not going to reveal the plot because many people have not have seen the movie. You do definitely watch it. But he's a pilot, and the plane's engines are on fire, and they don't work right after takeoff, and they have a decision to make whether to land in the Hudson River near New York or go back to the airport. And all the numbers and metrics and analysis that the person has to do, he only has a few seconds to decide. There is no luxury of hindsight and sit back and then analyze what is going to happen, what could have been done better or whatever. So in that split moment, he uses a very simple heuristic of the descent of the plane in terms of comparing the towers which were in the New York City skyline. He says, okay, my descent is this fast, I won't be able to make it back, I'm going to land on the Hudson River. And he miraculously saved a lot of people. The point I'm trying to make is the heuristic was always there because he was an experienced pilot. He had learned to hone that heuristic. He had learned to see what is the descent, what is the rate of descent of the particular flight well compared to some third object which is outside. In the same way, we in the day-to-day lives also have these situations where we are able to compare it. For example, a simple thing like touching a hot stove. Now, we might recoil our hand because the stove is hot so that we don't get burnt, and that's a heuristic. Our bodies and our minds have actually fine-tuned it in our system so that we don't keep our hand and burn our hand on the hot stove. Now this is a heuristic. Over a period of time, if you learn to cook, you realize that you have to bypass the heuristic in order to maybe make a roti or taste a particular dish you're making, because then you have to train your mind that okay, it's a little bit hot but it will not scald you, it will not burn you, so don't worry. You have to hone that particular aspect so that you won't recoil immediately. There is a little bit warmth around you. I'm just trying to give an example from day-to-day life. And the same way, if you do it in investing, you know that anchoring happens to you. You know that you are not going to escape from confirmation bias. You know that you're going to be I would say, a hound in terms of trying to find a cause and effect relationship every time, and every correlation will start making sense to you because of that particular bias. But then how to hone it, how to then build data habits so that you can statistical habits so that you can get yourself out of that particular pattern. So there is a nice book which came out recently based on a very nice course called Calling Bullshit. Sorry for the word, but that's the title of the book and the course. The course is available for free. The book can be bought on Amazon. So basically, the book distills everything that the course has taught by these few professors. I forget their name. Basically, they say that you have to learn good data habits to filter information and how to know that what you're reading is true. How to verify something is true or not. Again, it's not a perfect science. It is basically statistics applied over our behavioral way of thinking things. But it gives you a good idea that there are ways to mitigate all these biases, not to eliminate them, but helping you to learn how to uh, meaningfully use them in day-to-day life. So I would say confirmation bias is very useful in certain situations and not in certain. If you can understand which situations these are, then you can protect yourself a little bit better than just knowing about confirmation bias.
Yeah, so a lot of things in life, is also about doing it's very counterintuitive, and one of the most counterintuitive thing I have found is that you should always double down on your strength rather than working on your weakness, because that will pay you off more. Because the more you struggle with your weakness, actually it's not going to help you much. So rather than figure out what your strengths are and just double down on that. So I'm sure, and same will go for investing as well. I mean, I've been a trader on my life, and the trading mindset and the investing mindset is completely different, right? So and we talked about the information overload as well. And there is a saying that the more you watch your portfolio, the lower your returns are, because you end up taking some stupid decisions. But as a trader, you might have to watch it day in day out, because that's your job. So understanding what you're doing, I mean, if you're trading, probably you should watch the market all the time, and never let anybody disturb you during the market hours. But if you're investing, there's no point looking at the market on a daily basis, right? Probably. And I've been struggling with that, frankly. What is, because being a trader mindset and now trying to invest, how often should I look at my portfolio? Should I look at weekly? Should I look at daily? I mean, which is what I'm doing right now. Or should I look at weekly, or should I look at monthly? But trying to figure that out, as I think that's where the art of a good investor will lie. I don't have an answer yet, but I'm sure the one day I'll figure that out. So I'll come to investing in the global markets, as that's something you guys have done very proactively, right? So in the investing beyond borders strategy, the fund seizes a way, you guys seizes a way to diversify risk. Can you explain the approach here, and also, what ways do you suggest a any retail investors who wishes to invest in US or any other emerging market should look at these things?
Sure. So the idea behind going outside to invest in companies which are not listed in India is actually quite old. So we have been tracking all these companies like Google and the other IT businesses out there to compare with some of the Indian companies. And we realize that there are some companies which are really good, which have a growth trajectory for them going ahead. The businesses are well run, people are competent, but unfortunately they're not listed in India. So one thing was to obviously diversify, like you said, the geographical risk of a particular portfolio. So, for example, if something bad happens in India, there is a bad election outcome, or there is some INFS debacle, or some other news which affects the financial markets quite severely. But within India, that risk does not affect companies that are outside of India. So that is one way of protecting your portfolio. A little bit of volatility is reduced by doing that. So that is one primary reason to go outside. The most important reason, the second reason was these companies are not listed here, but these are growth engines. These are companies which are new age technologies available out there, and you use them every day. Like the smartphones we use, the softwares we use them every day. Unfortunately, the source of these softwares is outside of our country. We're relying too much on technology which is not made by us. So if you're relying on that as a user and you are sometimes paying a subscription, or you're the product, you're actually looking at the ad and monetizing those particular tools, why not have a chance to invest in them? So as an individual, the problem over there is you have to either go through the mutual fund route or a ETF route, or the second, which is the more expensive and less tax efficient route, is by actually putting your money, creating an account somewhere in a foreign market, a brokerage account like we create over here, and then you send your orders and trade accordingly. Then you have to also take on the currency risk. You'll be unable to hedge meaningfully over there. Plus, every time you send money from here to there, there is a forex transaction fee. If you bring money back here, there is another transaction fee. Then there is the dividend withholding tax, which most developing countries charge. There's so many other elements. You can learn about these things. It's not like it's impossible to not learn. And you can build a portfolio. You can also make returns on top of that. It's not a problem. But these two are the better ways of investing. So what we realized is when the mutual fund product was being created, this was the whole idea, that we needed at least a third of the portfolio outside this country from geographical diversification point of view. Secondly, there are so many good businesses out there which we would like to own, but they are unfortunately not listed in India. But these are global companies exposed to global markets. Their revenues are diversified, and they are new technologies and run by good people and available at discount valuations. So, for example, if you see many of the companies which are MNC companies in India, they trade listed in India. They're traded at a far higher multiple to even sales, cash flows, and earnings as compared to their parent companies. Now, in some of the cases, the growth rates have not been very different. It's like they are growing in a similar range. But at the same time, the valuations in India, which you pay for a domestic subsidiary, is much higher as compared to what we would pay for the parent subsidiary. So we found that arbitrage quite interesting. We used to own Nestle in the past in the portfolio on that particular arbitrage, the parent company, which is a Swiss company. Then again, when you are looking at these companies, you also get a chance to compare them with your domestic peers who are listed in India. So, for example, if you're looking at a global company like, say, a auto business or a IT services business in India, they're actually quite globalized, and the forces that affect an Indian auto or IT company will also affect some of the global companies. So the analyst actually gets a wide spectrum of data points to study when they look at these sectors, and they can have more informed insights rather than just looking at a very domestic issue and then not looking at a longer term thing as to what is happening across the world. So, for example, if you're an auto analyst, you need to know what is happening in the electric vehicle market space all over the world, so that it might eventually come to India. You cannot just sit on your laurels and say, okay, I only understand Indian auto companies, and it is 25 years away when EV will come to India, so I will not bother about the impact of EV. That's not how you would analyze an auto business. Or if you're looking at an Infosys or a TCS, you will want to look at companies like Accenture, Cognizant, or Capgemini, or all these businesses outside, because these are business models which are similar, but they are run in dramatically different ways, because you can see the difference in gross margins, you can see the difference in net profit margins of all these companies. So it gives you a more informed view while tracking these companies also, and you're also free to choose. And because we run a mutual fund product, it gives the investor a way to invest in rupees and take the money out in rupee. We manage the forex risk by hedging some of the forex currency risk ourselves, and it's a more tax efficient way because we limit that exposure to about 30% of the portfolio, which lets us become an Indian equity mutual fund. So there are several ways to invest. I'm not saying there is only one way to do it. Like I said, ETFs are there, index funds are there. You can put your own money there. You can also have a mixed approach like we are doing. I think people are spoiled for choice now, to be very honest.
So you mentioned that you limit that to 30%, but that 30%, does it vary, or is it also more or less static? I mean, is it like, do you bring that to zero as well, or it's mostly around, say, 25 to 30%? I mean,
So the max,
whatever you want to talk about in the public domain. I mean, yeah.
yeah, sure. It's in public domain. So
Yeah.
from a regulatory point of view, we cannot exceed 35%. But from a historical point of view, we have stayed in the range of 25 to 30 over the past 8 years.
Okay. Okay. So that's been more or less static, I would say. Yeah.
And there is
Uh,
opportunities also available. So it's also a function of having companies to buy and
yeah.
invest and stay invested in that period of time. So if valuations are at a tear in global markets and we're unable to find good ideas, we have an option to reduce the global exposure and invest more in domestic markets or stay in cash if both markets are equally expensive.
So, we have spoken about the international market, but coming back to the Indian market, are there any particular sectors, segments, how are you looking at the overall Indian space right now? The commodity has been on tear. Some of the, steel and chemical companies have done well. IT companies are also trying to catch up now. I mean, overall market has gone up as well. But from a next couple of years perspective, do you think certain sectors are going to do better? You want to talk about that?
So there are several sectors. So for example, I'll just walk you through the journey of the portfolio. So if you see the portfolio on an average of PPFAS mutual fund, the flexi cap fund I'm talking about, because it's the oldest scheme that we are running, that portfolio has not changed very dramatically. So we have a churn ratio of about less than 10% on an average. It has rarely gone beyond 20%. And what that means is when we look at companies, we look at holding them for at least 5 years, and we also communicate to investors that if you don't have a horizon of 5 years, please don't give your money to us. So from that point of view, we need to look at a longer term thing. So the current portfolio is structured around companies like technology services companies, digital advertising businesses, e-commerce, retail. Then there is auto companies. Then there are financial services companies, which are on the lending side as well as the non-lending and the transaction fee based side. So these are basically capital market intermediaries like exchanges, or even the lending side, we have only a portfolio of 3 banks. So what we realize is you build a portfolio of these things and you keep on adjusting based on your outlook where you think that the opportunity is better for a particular period of time. So for example, in the last, since the pandemic began, the lockdowns began, we strategically reduced our exposure to the lending businesses because we knew that these are good companies to own in the portfolio to some extent, but we did not know how badly the NPAs effect might hurt their balance sheets over a long period of time. So in the short term, we knew there will be some pain. In the longer term, these are good businesses. So we strategically reduced our exposure to some of the lenders, and we added to some of the intermediary companies like the capital market intermediaries I mentioned earlier. We also continuously kept on adding to opportunities where technology will actually improve the prospects of these companies, adoption of technology. So for example, in enterprise software, we have so many companies who are selling software, selling cloud services. So we added to that area of the portfolio. We realized that IT services business also, which were actually confused of the demand scenario in the first quarter of the lockdown, immediately following the next quarter, they were saying that, hey, there's going to be actually bumper demand. We can't hire enough. So in the quarter, you saw the reversal of demand happening in some of these sectors. And that actually also led us to make sure that, okay, this particular sector is important from a tailwind of business point of view. So we retain some of the holdings in that portfolio as well. So it's a diversification across different sectors. We hope that everything does well, but we know that realistically some of the ideas will not play out in the near term. They might take a little longer to play out, and till that happens, some of the other ideas like you mentioned, the cyclicals, the metals, and all the other ideas, they will take the market to a different level and we will underperform at that point. So that's perfectly fine as long as the longer term performance is stable, the absolute returns are good. At the same time, we beat the indices that we have chosen to a certain extent, we are okay. I mean, that's very comfortable for us as long as we don't lose money. So the point is protect whatever you have and not take some rash decisions because this is something which is fancy in the market. We have to chase it right now. We don't do that.
So just to follow up on that, I think in the recent communication, you guys have indicated that, you'll be investing more in small cap companies going forward. So what is the thought here? Is there a more recency bias to that?
So what the communication intended was, as the fund size has become a little larger, the ability to buy large quantities of a particular business, which might be a small, mid, or even slightly closer to the large cap, it becomes limited. One thing is, of course, market volumes are sometimes not in our favor. So you have to look for block deals, bulk deals to acquire the shares of a company you like. Secondly, you might also hit the paid up capital limit for each and every company that we are looking at. So if we like a business which is in the mid to small category, but we may not be able to pick up a large chunk of that business, but there are 4 or 5 other companies in the mid to size category that we also like. So we are okay to stretch a little bit in terms of adding a few more names in the portfolio. That's what we meant.
Okay. Okay. Let's come to let's talk about the risk management here. So, what's your and the fund's risk management process? How do you look at things from the risk management point of view?
From technical point of view, I think liquidity risk, some of the investment commitment risk. For example, if you bought something and you realize the business is bad, I mean, then you have to get out of it. You cannot just hope that the company does well. So selection risk is always there, where you build a portfolio of companies and some of them will not do well, some of them will really do well as a business, not as a stock. Stock is secondary. Second thing is that. Thirdly, the three cliched parameters I mentioned, right? I mean, do you understand a company's management well, their thought process, and their ability to run that business? Is this business going to be a good quality business? I mean, we are seeing the numbers today might be, say, a high return on capital business over the past 10 years, but will the next 10 years mimic what has happened in the past 10 years, or is it going to be materially different? And that is where we spend most of our time trying to understand as a team. And we debate this, even internal presentations debate all these things as to where this company is growing over a trajectory over a period of time as compared to some other company in the sector. And thirdly, we don't want to overpay, and that is more of a subjective call. I don't think I can ever pinpoint to you that this is the right valuation for something we are buying. In fact, we might, as we keep on evaluating something, we might keep on buying as the price has gone up over a period of time, because we feel that the business's value has also gone up in that particular period. So the valuation is justified. So you can keep on adding a business, like you say, you keep adding up as the price keeps going down or going up. At the same time, we may not chase something which has fallen quite dramatically, or we may also chase some stock which has fallen dramatically. We realize that the market has unfairly valued some company and the stock has been beaten down momentarily, and we would do that. Again, these are not very, I would say, written in stone kind of thing. It is something where we just know that in a particular business, it makes sense to chase valuation. The liquidity is there. In a particular business, it may not make sense to chase valuation because sector outlook may not be that great. So I think different companies require different ways of looking at risk parameters, but this is how you build a portfolio. And most importantly, you diversify. You don't get stuck in the particular sector with a large chunk of your capital over there, or you don't expose yourself too much to one particular company where you are unable to then mitigate your risk by, because your portfolio will move every time the company moves up and down in the stock market. So diversify meaningfully, diversify geographically, not overpay for good companies you like, and always have a grocery list of businesses which you like and you may want to buy or sell at a particular price. That is the broad risk management framework.
Okay. Uh, Now, the topic about the asset light or asset heavy, right? I mean, which has a stronger outlook as per you guys? Like, say, platform companies continue to grow shareholder value, or will they be outperformed by capex heavy businesses, which in current scenario looks like? What do you guys think about that?
I think to categorize just by capex is a little unfair, because where is the capex happening is a very important question to understand. It's like an incremental investment that the business is doing. If a capex is going in an area where the business has a high chance of growing their business because of that capex, and the return on capital will not suffer on that new investment, then I think that capex is justified and you should reward that capex because people have thought of putting that capital there. So you cannot create a company like Amazon by not investing in capex. So if you look at the asset increases in companies like Amazon or even Facebook, these so-called platform businesses, these actually have a lot of capex they're doing right now to scale their operations on the ground as well as in the cloud. So many of these companies generate that kind of cash flow to sustain the capex internally and don't have to go to the market, which is a good thing. You want companies to do that, and they're also able to expand themselves in different areas. So sometimes you might feel that, okay, if a company like Amazon made a phone, the Fire phone, which was a failure at that time, it did not catch on in the market. It never actually, nobody talks about that phone anymore because it doesn't exist. So yeah, it's a failure. They invested in that area, but did it break the company's balance sheet? No. So it's a calculated risk somebody took and it failed. And you cannot punish people for trying different things and getting some things wrong and getting some things right. It's less like a portfolio manager. You might have a portfolio of companies, but you might get some ideas wrong and you might get some ideas right. Broadly, if the direction is right in the good, it's trending upwards in a good direction, you have made more good choices than mistakes, then I think it's okay. And that's why I don't look at Capex as a binary thing, whether it's Capex or no Capex. Of course, you want companies which are asset light because it makes your return on capital look a little attractive. But if the Capex is in the right direction and if it gives you a strategic advantage, then I think it should be looked at in a different way and should be given the due regard in the valuation as well.
Yeah, so you're right. The biggest hallmark of a good management is how efficient they are from the capital allocation point of view, right? So the best uh, management is always the best capital allocator, and they will always create a lot of value for the company and for the shareholder over a long period of time. So I think we have spoken in good enough of time on spend on the whole investing part, and I want to come to some of your personal stuff as well. So I see that you are a very cross-sectional learner, and you apply learning from books, and you mentioned some of those comic strips, documentaries, and even movies. And you mentioned one of them, during our conversation. And for our listeners, we will actually put them all as part of our show notes. Uh, Beyond that, would you like to recommend any other books or any documentaries or anything for our audience?
So I think it will be unjust to recommend one or two things because there's so many things we learn from on a daily basis. So what I do is on my Twitter timeline, I keep putting stuff which I find interesting. So maybe if viewers are or the listeners are interested, they can keep a look at my Twitter timeline periodically. And I also learn from other people. So many people are sharing it. So I also share their what they are sharing, good podcasts or good documentaries, good films. I think the point is, I do it in a different way. I don't try and so of course I learn from other people's recommendations. And if somebody says this is a good book, I will put it in my reading list. I will buy it on my Kindle and read it later. But the most important thing for me is whenever I learn is what do I want to understand? And if that question is in my mind a little bit clear, then I know which areas I want to search on the internet and which books are relevant in that area. I can dig them out over a period of time. If particular movie has referred to something in a particular way, then you get a different context. So I read a lot of fiction. I watch a lot of fiction. I also read a lot of non-fiction and watch a lot of non-fiction. But none of them are. I cannot put a pattern to it. Say that this is how it all comes together because I don't know. This is all in hindsight. So when I look back in time, I know that okay, I've learned from all these things. But there are so many things which have not been very useful. They're just for entertainment. So they may have gone in the back of my mind and I've forgotten about them. But the things that stick with you is somewhere you can connect it to something which you're thinking about, and that's the reason you observe something which clicks something in fiction or non-fiction, and then that becomes part of your thought process. Then you build on top of that by reading something more. Then you extensively use search resources like Google and things like that, and you go into that rabbit hole of click link after link after link after link, and you keep climbing down that rabbit hole, and hopefully you stop somewhere meaningfully when you are satisfied with this enough that you've learned. I think the more interesting thing is being in an organization like PPFAS, it gives you that opportunity. So, I mean, I told you about the library, right? So we have been carefully curating the library. Now it's about 450 books right now. And even we encourage all the staff members, not just the research team, to just go and pick up a book from the library and read. It might be something which you never read about. It might open up some thought process in your mind, which will be useful for you personally, or might be useful in your day-to-day job, or it may not be at all. It's just for entertainment. And I think you pick something up and it then connects different things. You will not know until you read it or you observe it. So we also screen documentaries and films at the office. Now, unfortunately, in the pandemic, we haven't been able to do that. But we used to screen them just to know that, okay, we have learned from this particular thing. Can we watch a documentary which talks about it in a better way? Because sometimes watching something in an audio visual manner sticks with you much longer than reading a book and then visualizing it and remembering it. And with books, the problem is you have to keep going back to them. You cannot just read it once. And so for me, at least, I cannot read it once and remember everything. I have to read something two, three times to actually etch it into my memory that this is something which is very important. So I meticulously note down everything. Everything is digitized now because I used to have these diaries and notebooks in the past, which became very hard to index and find information in. So in one streak of madness, I just scanned everything and put it everything on the computer. And I realized my handwriting was not good enough to recognize everything. So eventually, over the past 4 or 5 years, I've realized I've digitized most of my notes, so I can search and go back to the archives and see if something is worth remembering, something is worth using, something maybe just useful to read again because it was a timeless thought which you wanted to go back to. I think that was enabled even because of the organization which pushed it to learn all these things. So you can build these habits, push yourself to aggregate data properly, push yourself to learn from different sources. And of course, you talk to different people. They also give you good references to read, good films to watch. And you, fortunately, thing like Twitter will allow you to broadcast it to everyone. And then from some corner, somebody will DM you, hey, did you watch this particular movie about this particular thing which you had tweeted about? Then it's gold, right? I mean, you get so many different resources to enjoy uh,
So,
I think on the comfort of your home.
yeah, a couple of things, I've realized that I buy too many books than I read. So a lot of them books are just lying on my bookshelf and, which is I've not read. So I don't know what's your reading style like. Secondly, you mentioned bit about the journaling part, and a lot of people are, and I've also started using some of this new age form, right? Room research, notions, and, those are basically databases to put down some of the thoughts so that you can reference them later. So I don't know what's your, I mean, you said that you digitalized most of this thing and you can reference back, but any other thoughts, I mean, on both the topics? One, how do you read so many books, which I find very difficult, and how do you journal your thoughts?
Right. So I'll talk about journaling first. That is something which I've evolved to my own level of comfort now. And because, so I use tools which are expensive, but they're not required. You can also use a cheap 200 rupees keyboard and a basic desktop computer to type everything and put it into something like a Google Drive or something where it's accessible on all your devices wherever you want it. So on Google Drive, the basic memory you get is 15 GB, I think, and that is more than sufficient for all your emails, photos, everything combined if you manage it properly. So one thing is to have some sort of a cloud interface where all your devices can access to that, and your thoughts are there. I mean, if you are suppose caught in a waiting line in a queue somewhere, and you have 1 hour left to reach your window or whatever you're doing, yeah, pull out your mobile device and read your notes if you feel like it. Pull out a podcast and listen to it, and take your notes in the Google Drive or Google Docs so that you can go back to it later. So that habit is something day to day. It comes up based on everybody's comfort level. People pick up which tools they want to use. I, in fact, wrote a nice post called Productivity Tools for Investors. I'll link it up for you later so that you can put it in your show
Yep.
notes. It's summarizing all these things into that particular post. And a lot of things are not changed yet. And on the reading part, I have the same disease like you. I buy a lot of books, don't finish a lot of them. But over a period of time, I realized that I skim very heavily. So I go through a lot of material very quickly. I skim through many topics. And if something catches my attention, which I want to read further, so that need to read a particular topic or understand a particular topic, if it's there, then I put the effort to read it completely and then find other material which is allied to that or contrary to that, or something which people have said that these two things go together if you read it well, or these two things if you watch together they go well. So I spend time from that intent point of view. So once the intent is clear, then I go deep dive and finish books cover to cover, if at all, even sometimes twice. But if some intent is not clear and I just want to know what this particular guy is talking about, so if there is a non-fiction book, many times what happens is, to promote the book, the authors will go on a podcast tour and they will talk about their ideas in that book. It's just good to listen to a podcast interview with the author. Then you get a general gist whether you want to deep dive into the topic or not. Secondly, if you think that is worth deep diving into, but you don't know if the 300 pages, 500 pages is something you can actually have time for, then start skimming through the chapters. So I read on my Kindle, so it becomes very easy. In a little bit of time I find somewhere, I use it to just go to the chapters quickly, just to see a few paragraphs, few topics that I discussed. Go to the index of the book and see what topics have been covered in what depth. So you can just go back to some topics, and in the Kindle you can actually click on the index item, it goes to the page where you want to go. So it's very useful. It's just like a normal book in a way. It's a tool. Again, you can do it with a physical book also. There's no problem with that. The problem with physical books is I don't have storage space anymore. So I gave away all my physical books and I exclusively read on the Kindle now. So yeah, it's a tool that you use. Eventually you adapt to your lifestyle, what makes sense for you. But my thing is, go with the intent, focus on what you want to learn, and then learn whatever you can about it. Or if you want to just be broadly aware of things, just skim through a lot of things. You may have purchased the book, but it may not be worth reading the entire book. the author got its due worth in terms of the money you paid for the book, and you learned a little bit about a topic which you otherwise would not have learned about. And maybe in the future, you know that this topic you want to learn, you know where that book is in your collection. So I think it just opens up these weak links to various topics in your mind, which you can then strengthen later on by reading more about them and make it into a highway.
Yeah. No, that's a great one. Our show is called Breaking Investment Stereotypes, and you've been a big part of the market for decade or so. So, any investing stereotypes that you want to highlight for one to avoid?
So I think I have succumbed to this for such a long time. Uh, Everybody knows that correlation is not causation.
Hmm.
Uh, but the problem is we are such sticklers for causation. So we just want an answer for everything. That why this particular thing happened, and how it played out completely. We might see the outcome happen, and we might immediately want to go back and go to the cause of that particular thing. I think that is the biggest stereotype I have seen. Where of course we know that it is not correlation causation not the same, but trying to correlate and force fitting it to a cause and effect scenario is something where is the biggest problem of most investors. I think I have succumbed to it more than many people I know, because every time when I go back to my notes, I realize that okay, I've thought of something in the past which was just a weak correlation, which I force fitted into all the theories that I want to talk about the business, and eventually it linked me to direction. If it and the worst thing is if it works out in your favor, if you accidentally make money on that idea, it cements in your mind that you were so right about this particular correlation being actually a causation. And if you lose money, you will curse yourself. Oh, how can I make a mistake like this? And so I think if you are able to disconnect those two things properly, and I have not been able to yet. I'm still learning. But I think correlation and causation, that particular debate that happens in our minds, the urgency of finding a cause. So, for example, now some things are so difficult for me to understand. I've realized that I will not be able to build my circle of competence in this particular industry. So, specialty chemicals, for example, it took me a long time to understand it, but I have not been able to build a good grasp of how these businesses actually work. So I've given it to somebody else in my team. That person is better at understanding that sector. So when I realized that I cannot do it, then I had to like physically keep distance from that particular topic. And of course, it will help. It will not help us because sometimes there will be some good companies when the analyst will have to then highlight it to us, and we will have to then make up our conviction based on that person's conviction to either invest or not invest in those ideas. But yeah, I think if we can control that particular causation correlation thing a little better, it is useful because not everything can be answered. Some things are just too difficult to understand, and you just have to let it go sometimes. Maybe it comes back to you later in a more simplified manner. Somebody does a good job in simplifying it for you, and then you suddenly opens up. Oh, no, this is how it happened.
Who will be your investing ideal and a life ideal? Whom do you look up to?
Wow. So I think I look up to people who are the closest to me. So I used to look up to Parag Bhai a lot. I look up to Rajiv a lot. There are a lot of other people out there who I know a little bit about them. So I cannot say I look up to them completely in all aspects of life, but at least in terms of investing, in terms of doing the legwork to understand things, I think most of the peers who are there in our market right now, the fund managers, the PMS managers, all these people, when we interact with each other, we realize the amount of effort people put that actually energizes me. It tells me that okay, this is okay. If somebody else is doing so much effort, what stops me from doing that? Because we are in the same business, we are earning money in the same markets, we are probably having same investors also sometimes. The effort is not optional. You have to put the effort, and that energizes me. And like the conversation we are having right now, I've had the privilege to talk to many people in the industry. Also, the same thing, that how did you pick up a habit of reading books? How did you pick up a habit of developing your competence in this particular sector? So, for example, one thing I liked what Rajiv Thakkar does, is he now, since everybody works from home, it's a little difficult to do that. But when he used to come to office, he used to take one day of the week for just long-term reading, just reading. So at that day, it was a Tuesday of every week. He used to just say, okay, this day I'm going to devote only to reading what he wants to read. It can be either about the businesses that you're tracking or some non-fiction book or some fiction book, whatever he wants to read. Is to isolate himself into area where people could not physically reach him immediately, but we can call him if it's an urgency or emergency. But I like that habit a lot, and it's a very interesting thing, which even Cal Newport talks about in Deep Work. That you give yourself that time to absorb something for a long stretch of time with good concentration. Nobody can distract you, nobody can disturb you, and some of these habits you pick up. So I think there's no one person I would say, but these two people who were closest to me, I used to see them every day. They are the great influences for me in terms of work ethic, and other people I've learned bits and pieces from, and I'll keep learning from them. So it's a continuous process. I cannot say that, okay, this is it, I know everything that I'm supposed to know right now.
No. We're coming to the last part of our, talk. So this is a question I ask everyone in our podcast, and I know that you are still very young, but if you have to give one or two advice to your Raunak Onkar 20-year-old, what will that be?
I think, okay, this is not a regret or a refrain, but I would tell my 20-year-old self to get a good night's sleep, get up early in the morning, exercise every day if you can find a time, and keep your energy level at a good level. So there are a lot of unhealthy habits I'm trying to unwind myself of, and because you know that information flows every day, you want to know whatever everything is out there. It becomes an addiction afterwards, and you spend too much time not taking care of your body, not taking care of your mind, which is through rehabilitation, rest, and all those things. I would say you will still be able to do everything by developing good habits to learn. Try and sleep a little bit longer at night. Try and get a little bit of a rejuvenation for the next day. So I used to famously sleep very less, and I used to feel proud about it until I realized that the long-term effects may not be good. And then I started reading about the research. Then I realized, okay, this is not a good idea. So then, which forced me to build good data habits, so that, okay, how can I do this same amount of work in less time? Now that you have built these huge information sources coming towards you, you have to filter them. So then you become a little bit more ruthless in managing your time. You make sure that you give time to certain activities more than you do to certain activities, and then you also focus on sleeping. So what used to be a rounding error of the day, that whatever hours are left you used to sleep, that became now a priority, that you have to sleep for these many hours. Then how much time is left, how much time you commute, how much time you spend to reading, how much time you devote to your family, everything else. So I think I would tell myself that, you focus on your sleep, focus on your mental health, focus on your ability to manage your day-to-day time in such a way that you give importance to your body as well, not just your mind. So I think, I don't think there is any other advice I would give, because I would repeat everything that I did, because I reached this level, and I would say this is a repeatable thing I can do afterward. But if one thing I could change, and I will inform that person, is to, you can do all these things, you can get to the same level, but you can also do it with good sleep.
Yeah. That's a very interesting and important point which you mentioned. And there is a guy called Mathew Walker. I don't know whether
Yeah.
you've heard about and read his book.
Yes.
So he's got an interesting, you can find about his talks on a lot of podcasts, and he's a good guy to read about and listen to when you want to know more about how important sleep is. So with that we come to our conclusion. And Raunak, thank you so much. It's been a very great conversation we've had. Our listeners would have really learned a lot from this. So thanks a lot.
Thank you, Rajkumar and Multipie, for inviting me. It was an absolute pleasure.